With this investment trust, we're looking to build a portfolio of companies, each of which are high conviction stock ideas for us, but quite different in their characteristics. So we can have a concentrated portfolio which is still diversified in terms of stock and macroeconomic risks in the portfolio. We're also looking to achieve income, so income with growth in a concentrated stock picking portfolio, which will offer, in our view, attractive long-term total returns. I will be managing the investment trust. I've been investing in emerging markets since 1999. Charles Sunnox will be assistant fund manager on the investment trust. Charles is a fluent Mandarin speaker. He's lived and studied in China and has a lot of experience in that part of the world, as well as broader emerging market space. In addition, we operate as part of a team of 8 emerging market specialists with expertise across a whole range of emerging market regions and countries. So for example, India and emerging Europe are 2 areas where we have dedicated funds and a lot of experience picking stocks in those markets. So the investment trust is an interesting vehicle for us because it offers flexibility over and above what we would have in an open-ended fund. So, for example, because of the closed-end structure, we're able to own a higher proportion of small caps and also have a higher exposure to frontier markets. And both of those are really interesting parts of the universe for a stock picker because there are high alpha generation potential opportunities, companies that are under-researched and have very good growth prospects, which we can consider as significant investments to hold in the investment trust. The investment trust also offers us the flexibility of having a degree of gearing in the fund. Now, gearing will never be a principal driver of returns, but it is a useful facility to have at times when we feel that valuations are very attractive, and that can be supportive of long-term returns of the investment trust. So we will have up to a maximum of 25% exposure to frontier markets in the portfolio. We strongly believe it makes sense to have frontier exposure in an emerging markets fund for a number of reasons. So for one, there are some excellent stock picking opportunities in frontier markets, companies that are under-researched, and therefore we have the opportunities to discover something that the broader market hasn't priced in. Also, in frontier markets, because the economies are often less mature, you have a structural growth story in areas such as financial services and the penetration of various consumer products. And that can act as a tailwind to company earnings over a number of years. And the final point I'd make is that because many frontier markets and frontier market stocks have got low correlations with emerging markets as a whole, they're a really useful tool for diversifying risk, and potentially frontier exposure can improve the overall risk-reward proposition of the portfolio. I think about diversification in 2 ways. So first of all, diversification within the trust is important, and it is possible because we have a very diverse asset class across emerging and frontier markets. Now, I think diversification is also important from the point of view of an investor's overall portfolio, and for an investor considering an investment in the investment trust, it's offering international diversification to, for example, a sterling-based investor's portfolio. And as we've seen in previous periods of currency volatility, that can be a very important diversification to have. So the opportunity for income investors in emerging and frontier markets is really interesting, I believe, because it is possible to achieve quite a respectable level of income and at the same time still have significant future growth potential. And the reason I stress the growth potential is that often in developed markets, if one looks to achieve a high absolute level of dividend, then the trade-off is that one has to invest in companies that have got less than exciting growth prospects, often companies where the reason the dividend is high is because the growth prospects are questionable. Now, in emerging and frontier markets, we have plenty of examples of companies that are paying significant dividends, that have a history of paying dividends, and which also operate in areas of the market that could see significant future growth. Change-based investing is quite different to the way in which many investors invest in emerging markets. So change-based investing is about looking at individual company, individual stock opportunities and identifying where there is a material improvement that the market hasn't yet understood or priced into the stock. So we look at each potential investment on a case-by-case basis, and we're looking through our research, through our meetings with companies to identify that change. It's quite different to a quality approach, which is very common in emerging markets. Quality approaches tend to rely on a demonstrated history of quality practices by a company. We're often finding companies where there's a big improvement, and so it wouldn't necessarily show up in historic numbers that a company is doing something very positive that will drive future earnings, and we're capturing that change. So one of the key attributes of our investment process is that we have a very broad investment universe. So we have over 4,000 companies contained within what we call our Quant Change Monitor. That's a screen covering the whole of our investment universe. What we do is we look for companies where there is evidence of a change taking place that may be coming through in those numbers. We also look for companies through other routes, through doing a lot of company meetings and looking to identify change in those meetings. Now, when one of these company meetings throws up a significant change that we believe may not be priced in, we write that up in a structured research note. We have a common investment language across the team, and that research note is peer reviewed so that we can benefit from the experience and insight of other team members and really understand whether we've got a high conviction idea on the table being proposed. So the investment trust will have a maximum of 20% gearing at any point in time. We anticipate a more typical level of gearing will be around 10%, and at times you may see that there is no gearing employed if we believe that at that time valuations are looking fuller. So the differences between this investment trust and our unit trust are that the closed-end structure enables us to have a higher exposure to small cap and to frontier markets than we have in our unit trust. Our unit trust does have both elements, small cap exposure and frontier exposure, but we can simply have more of it in the investment trust. The income component is something which is distinct in the investment trust, and the gearing is something which differentiates the investment trust from the unit trust as well. That added flexibility is something that's unique to an investment trust structure. So in summary, what we're looking at is a portfolio that is concentrated in terms of number of stocks, which is built from high conviction bottom-up ideas, which is diversified by geography and by industry, and where there is the potential for significant income, but where that income is combined with good future growth potential as well.